end of April, big headline, same drug, same thing. And then fast forward to 2 dates in May where we saw good news on vaccine. The fact that we had one potentially in short order and that one of them was in looking at human trials starting before too long. And those were the 4 best performing days in that span of time since mid-April. All of it, you add those 4 days together, as you said, it was more than the number of Dow points that have the market has gained since that point in time. So it just shows you that there's also this hope. There's virus-related treatment, therapeutics, vaccine-related hope that is driving some of these big days in the market. And let's hope the market is right in kind of cheering that good news. I hope we
Yeah.
get, but it also highlights that hope around the virus itself and treatments is a big part of the rally in the market. In terms of the sector performance, what I show here, there's 3 different color bars for each sector, and I think very important in highlighting the 3 phases. So the blue bars represent the bear market phase. So from the high in mid-February down to the March 23rd lows. And you can see the carnage across the board with energy taking the biggest hit. And then the yellow is from that low, from the March 23rd low to May 14th. Now, I didn't arbitrarily pick that day. I'll explain in a second why I picked that date. But that span of time, you saw a bit of a reversion trade. So you saw kind of a mirror image in terms of energy. Some of that was fundamental, some of that was technical, some of that was short covering. But then aside from that, the big gains were sort of concentrated in healthcare technology. So there was a focus in areas that were seen as either beneficiaries of the COVID environment or at least not hurt by the COVID environment. Then the shift happened in mid-May, and that was a shift toward more traditional cyclicals, where industrials finally got a bid, where financials finally got a bid, the real estate investment trusts. You saw the shift down the cap spectrum. You saw it in value. That's when the market went from, okay, we're going to have not a great recovery, and it's really going to be concentrated only in areas where growth can be maintained, to, hey, maybe this is more of a V-shaped recovery, and so we're going to sort of put on this cyclical trade. So those are the 3 distinct periods. I think there was some rational behavior in that middle phase, given the concentration in areas that were seen as beneficiaries. And I'm not saying a move to broader cyclical leadership is irrational. I hope it's not. But it does suggest now that the market is pricing in a pretty broad recovery, not just in areas that are obvious. And the next slide, this just looks at sectors, but you can also see it in terms of the Russell indexes. So you can see that small value got hurt most during the bear market. And then during that sort of recovery phase, you saw large growth was where all the action was. But then since mid-May, when you broadened out the market into this more classic cyclical leadership, again, you're seeing it down the cap spectrum and more toward the value side of the equation. That's hopefully an important tell by the market, but the market may not have this one right. So that's a risk. That said, it has allowed the market to broaden out a bit here. And I think what are the final 2 charts just show that there had been a lot of concern about the narrowness in the market, but now we're seeing the advanced decline line catch up to the improvement in the market. We're at almost 100% of stocks in the S&P are trading above their 50-day moving average, much less for the 200-day moving average. But that's also generally a healthier condition for the market. Now, it also tends to show some overbought conditions here. And historically, even when after conditions like that, where it ended up looking good a year out, you tended to have some consolidation in the next month or 2. So I don't want to contradict the data here by saying this is a surge in breadth. This is a good thing, but now we're overbought. That's not inconsistent with history of maybe needing to take a breather here, even if the market is right that we're soon going to be on much better economic footing.
So one thing I want to add to that, and you and I were talking about this before we got on the air, is this idea that even though we've seen this substantial move off the bottom, we've seen volatility indicators like the VIX come in, right? And we're not trading at 80, 70, 60, where we were before, but we're still at 28.
Yeah.
And, the VIX has been up the last couple trading days while the market has been up as well. And usually what that indicates, and this is not an always thing, but it's usually an indicator that, some of the more sophisticated hedgers out there are starting to maybe buy in some protection on some of their long portfolios. Doesn't necessarily mean that they're selling out of their equity positions, but they might be at least putting some of those pieces in place to hedge against some of that risk given the big move off the bottom that we've seen. And I think it makes a lot of sense, especially when you show the data that you just showed.
I think that's a very accurate assessment. And I look at all sorts of real money gauges of what various cohorts of investors are doing. And rightly so, there's been a lot of attention on really small speculators, and certainly a lot of articles out there that mention our company's name, as well as, the likes of the Robinhoods of the world in terms of this big surge in smaller accounts being opened and more activity and trading on the long side. But to your point, you are seeing movement by the large speculators to hedge, whether it's against volatility or just take short positions to offset some of the gains that have occurred on the long side. And you are seeing some of that movement by the smart money to sort of figure out how to lock in some of these gains. So I think that is important to be mindful of. It's not so extreme that we should see it as a glaring warning sign in the near term, but there is a shift toward maybe taking some of the bets off directly or indirectly.
All right, Lizanne, do you got time for 2 quick questions?
Yeah, sure.
Okay, first one, it comes from Chuck in Oklahoma. He says, Lizanne, what are your thoughts concerning the future expected earnings over the next couple of years?
Well, the short answer is I don't know, nor do the analysts even covering companies at this point. I can tell you that right now, the consensus, bottom-up consensus for 2020 earnings is about $125. The consensus for 2021 is about 160. So that's and then top-down estimates are similar. Top-down estimates, so those are estimates by strategists or economists who are just making sort of a generalized guess as to what the decline in earnings are going to be, as opposed to analyzing company by company. Those are similarly in that kind of 125, a little bit better for 2021. So that would put the multiple even on next year, looking at next year's earnings. Not cheap by any means. Yeah. So then, to explain that away, people are saying, well, let's look out even further into 2022 and do some sort of normalization of earnings. But frankly, what are normalized earnings in this very abnormal world that I don't think is just abnormal in the near term? We have to really start to think about some of the secular changes that are coming out of this economy. What the future of our economy looks like relative to the past of our economy. And I'm just not sure it looks the same as it has been. So I think it's premature to attempt to normalize earnings. I think right now the level of calendar year 20 and calendar year 21 matter in terms of valuations. And unfortunately, on sort of a strict historic basis, they don't look cheap. You could argue equity risk premiums are cheap, but on traditional earnings metrics, the market's still pretty expensive.
All right. Sorry about toggling through that real quick, everybody. Because this is the last question I want to ask you real quick, Lizanne, and I think this is a really good one from Joel in Texas. So, Lizanne, we covered the phase 1, the phase 2, the phase 3 in terms of over the last couple of months, the sector performance. What are your expectations for potentially phase 4?
Well, the next phase, in a perfect world, sort of continues to look like the current phase, where you continue to see a broadening out of leadership and you see consistent participation by the more cyclical parts of the economy, and it's borne out by the economic data that starts to show, meaningful recovery, not just blips off the low, but some traction in some of the data that has started to turn. So it would really be more of an expansion of this third phase that is fledgling at this point, arguably. The concern is that the reality of what's ahead of us is more like what phase two reflected. That yes, we'll see some nice rebounds off of depressed levels, but that it's going to be an economy that doesn't grow robustly. We don't see a return back to prior levels, particularly in many of the consumer and services oriented parts of the economy, that we're going to see a more narrow pocket of winners in terms of industries and companies. So that would be the other potential, that the shift in an economic phase brings us back to more narrow leadership in the market. And I think the path to go there, if that's where we go, is probably going to be a pretty bumpy one. I don't think you see a market shift to, okay, we thought things looked great and we were going to
Right.
rebound fairly quickly, to maybe we're not. This is going to be slow growth. This is going to be like rolling W's. We're going to have some serious dislocations in the economy. I don't think we would morph back into that environment in the market without some pain along the way.
Well said. I think maybe in the next couple of months we'll have to have another one of those alphabetic analysis where what letter are we looking for in the recovery. Well, Lizanne, thank you so much for your time. Appreciate having you on today.
Thanks, everybody.
All right. Everyone have a great day, and we'll talk to you in a couple of weeks. Bye-bye.